beauty of an absolute return strategy, particularly one that's market and style neutral, is it doesn't really matter what the investment environment is. So in an environment where inflation's picking up and interest rates are going up, as long as the stock selection skills there, those strategies are able to deliver returns above a benchmark like a cash rate. The big difference to a passive or a long-only investment strategy is those strategies can actually fall a long way in those sort of environments. So whereas high inflation is a real challenge to broad risk assets, and you can get an environment where bonds and equities and property are all falling at the same time, a market neutral strategy is able to deliver returns independently of those sort of environments. So for instance, the sort of environment we're in now, where inflation is much higher, it's an environment where a market neutral strategy can really outperform those passive long-only strategies. Market neutral strategies have generally done much better than passive and long-only strategies through 2022. But that will still come down to individual manager skills. So some have obviously done better than others, and depends to what extent they actually adhere to market neutral. So some absolute return strategies can have more or less exposure to the market. We tend to run very strict zero market exposure strategies. So when we saw the market fall quite aggressively with bond yields going up and prices falling and equity markets falling, particularly through the first half of this year, our market neutral strategy was significantly outperforming by actually going up in those environments where markets were broadly falling. That outlook is always uncertain for the rest of 2022, but with central banks still very focused on controlling inflation and the prospect of a recession looming, there's still a lot of scope there for market neutral to continue to outperform more absolute directional strategies like long-only equities. We do see investors broadly using more liquid alternatives across their portfolios, and that's become, I think, particularly stark as we've seen central banks move away from zero interest rates and start to tighten, and investors focus more on the prospect of higher inflation and lower returns from broad risk assets like equities and bonds and property. So we are seeing increasing allocation there, but where that comes from really comes down to the individual investors. So some view market neutral as a cash alternative, because we do deliver cash as a benchmark return. So sometimes an allocation's coming from a broader cash allocation. And then there are those that may want to actually just diversify their broader risk assets, so reduce their exposure to bonds and equities in the portfolio and have some more liquid alternatives that are less correlated with other risk asset classes and helping improve the overall risk return outcome of their portfolios.